Hi everyone, welcome to my YouTube channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. My mission is to become Google Map for hardworking Canadians just like you and I, seeking financial freedom. And today's topic is about losses. Recently, I've come across so many different headlines, including stock market plummeted, interest rate rises, so the real estate market plummeted. Rumor on the street is that there is about 20% decline in property value. I don't know if it's true. Don't hold me on that, okay? There are people losing money on pre-construction condo because the builder cannot come through, so they put out $150,000, $200,000 deposit. They are exposed to the risk of losing that particular deposit. We saw that the UST, the crypto coin, declined drastically last week in terms of value. So many different type of losses come out. And I just wanted to use this particular video to share with you how you can further minimize the losses and help you recoup some of the losses that you incur by reporting it on your tax return. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. Okay, when you incur a loss, not every loss is the same. There are two different types of losses. One is called capital loss and the other one is called business loss. And what is a capital loss? Well, when you buy long-term real estate, when you make money on a long-term real estate investment property, when you sell the property and make a profit that you've earned rental income on, that profit, that $100,000 profit typically is taxed as capital gain. And capital gain is 50% taxable. And when you lose money on the same transaction, let's say you lose $100,000 on a real estate deal that you have always used it as rental and your intention is always to keep it as a long-term investment, that particular loss is considered capital loss. And capital loss, similar to capital gain, is only 50% deductible. And capital loss can only be applied against capital gain. If you have capital gain reported in the same year, you can use the capital loss to offset against the capital gain. But this particular capital loss can only be offset against capital gain. Depending on the year that you incur, currently capital loss is only subject to 50% taxable inclusion rate. At some point in our history, that was 75%. There was a lot of speculation that capital gain inclusion rate could increase, which also means that capital loss inclusion rate that incur in that particular year could also be increased. Capital loss can be carried forward and applied to capital gain you've earned in the last 3 years, or you can carry the capital losses forward indefinitely and to be applied against the future capital gain that you earn. Capital losses created from one type of investment can be used to offset against capital gain earned from another type of investment. As an example, your crypto losses can be used, your crypto losses can be used to offset against the capital gain you've made from selling your long-term rental. So when my clients tell me there is no reason to report a particular type of income, or capital loss, I would go back to tell them the benefit of reporting them on their personal income tax return as it incurred, because all these losses can be applied in the future and you don't know when you would incur the capital gain. Now, the second type of losses available is called business loss. If it is considered business income, if the transaction you're doing is considered business income, 100% of the income is taxable. This is the case for like land developers, builders, people who flip properties, etc. If they lose money on the deal, 100% of the losses can be used to offset against other business income. If you own these deals in your personal name, you may even be able to use the business loss to offset against other sources of income, such as employment income, RSP withdrawal income, interest income, etc. Business loss, similar to capital loss we discussed earlier, business losses can be carried back 3 years and applied against income that you've earned in prior years. And business loss can also be carried forward for 20 years only. So there is a definite deadline to apply the business loss. As a taxpayer myself, the bias is always to report all the gain as capital gain, because all capital gain are only 50% taxable. So you're paid less tax. And as a taxpayer, we want all losses to be reported as business losses, because all the losses, if it is reported as business loss, is 100% deductible against all sources of income, not just capital gain. So how do you really determine whether a particular type of transaction is considered capital loss or business loss? Let's dive deeper into it. Criteria to determine whether a loss is considered capital loss or business loss, there are several. This all goes back to a bunch of criteria that's set out in court cases, multiple court cases, as a matter of fact, to decide and help CRA decide whether you are operating the transaction and the transaction that happened that caused the loss as a business, or you're doing that as incurring it as part of doing a long-term investment. So generally speaking, CRA looks at the following criteria. The first thing is frequency of transaction. So how often do you do this type of transaction? How often do you transact on the underlying asset? Is there a pattern of behavior, or is it a one-off transaction? Now let's use an example to explain. If you are trading crypto all the time, every single day, multiple transactions, you get in and out of the transactions to make a quick profit, you time the market, and that typically, based on the frequency of transactions, CRA is going to argue that the transaction is on the business side, and therefore 100% of the losses that you incur would be considered business loss. Using another example, if you are in the business of owning long-term rental investment, it is a long-term investment. You collect rent and you buy properties, you trade them very infrequently. You don't buy and sell because the cost of owning rental properties and selling rental properties are extremely high. So in that particular situation, because you rarely trade these type of properties, and based on the frequency of transaction, it's more likely that CRA is going to treat that transaction, the loss from that transaction, on the capital side, and meaning that if you incur a loss on the rental property, on the sale of a rental property, it's treated as capital loss. The second criteria that they are going to look at is how long you own the underlying asset. Period of ownership, duration of the ownership. Now, using an example, the same example as earlier, the long-term rental portfolio, the longer you hold your rental asset and earn rental income, the more likely you can treat that transaction on the capital account. Using the similar example that we used earlier with crypto, you day trade crypto on a daily basis. So the duration of ownership of each crypto asset is relatively short. It's only a few hours or maybe a couple of days. And with that type of period of ownership, it is more likely that CRA is going to look at the transaction, the gain, the profit that you make, as well as the loss that you incur on the business side. So all the profit that you make would be taxed as business income, and all the losses that you make, you can argue that you have a stronger argument that such a loss is considered business loss. Now the third criteria is how knowledgeable are you in the market? And does the transaction form a part of your regular business? Now, it makes a difference depending on what you do for a living. So if you follow crypto and you do day trading on a daily basis, you are subscribing to multiple different crypto daily news and platform, getting your insider knowledge, and you are an engineer that work in the field, all these evidence come together to show that you are extremely knowledgeable in the market. If you are extremely knowledgeable in a particular market and in the market that you are doing the trading, chances are the transactions that you are conducting in that particular market would be more likely to be treated on the business side rather than on the capital gain side. Now, on the other hand, if you are not a real estate investor, or you have a full-time job, you are an accountant working for one of the biggest grocery chain in the country, and you're just internal accountant, your professional knowledge has nothing to do with your rental property, and you're holding rental property long term, chances are it is less likely for that particular example for the accountant to be considered knowledgeable in the real estate market, and the transaction that she's conducting in the real estate market is less likely to be treated on the business side. So the profit that she made from the rental property, sale of the rental property, would be more likely to be treated on the capital side, so she could report it as capital gain. The fifth criteria is how much time you spend on studying the market and finding deals. So many real estate investors spend a lot of time doing wholesaling. They network with a lot of wholesalers trying to find the worst shaped type of properties to purchase and invest in, and they purchase a property. They're not afraid of the distressed property. They go in, get the entire thing upgraded, and then turn around and sell the property. As long as the numbers make sense. Now, if you spend a lot of time studying the market, spend a lot of the time networking with people, just so that they can bring you deals, CRA look at that type of situation, that you are operating, more likely that you're operating a business, and therefore the income that you make from flipping would be considered more on the business account, not on the capital gain basket. On the other side, if you are an investor, real estate investor, and you don't spend a lot of time learning the market, you're just happy with that one long-term rental that you own, you know that it could be rented for more, but you rarely have changeover of tenants, so you don't study the market, you don't care if there are deals out there or not because you're not in the position to buy. So you spend very little time in terms of finding off-market deal or finding any deals to begin with. It is less likely that CRA would consider the sale of your rental property on business accounts, meaning that 100% of your profit would be taxable. So it's more likely the CRA, based on this criteria, to consider that the transaction is on the capital gain side, meaning that the profit that you make would only be 50% taxable. Now, the sixth criteria to determine whether a transaction is business loss or capital loss is based on financing. So financing matters. If you are borrowing money to purchase the underlying assets. So if you are buying stock using using a margin is just the way that the bank provides stock trader an option to essentially trade on short-term loan. In the case of a stock, if you are primarily using margin to finance the purchase of the stock, then it is more likely that you are trading on the account of business. When you're trading on the account of business, meaning that the losses that you incur would be 100% deductible against all sources of income, you would need to be able to show to CRA why it is considered business. Now, on the other hand, in the real estate investment world, if you're using short-term financing, most flippers want short-term financing, 1 year term or even private financing for quick closing purpose, just to get just so that they could get the money into the property as soon as possible and quickly flip it out to the market to make the quick profit. In those certain circumstances, it's more likely that CRA is going to consider the profit to be on the account of business, meaning that the profit that you make would be considered business income and 100% taxable. And so is the loss. If you incur a loss, the loss should be considered on the account of business, and therefore the losses can be 100% of the losses can be used to offset against all sources of income. Now, the seventh criteria is advertising. How much effort are you putting in to make it known to public that you're trying to find deals? In my earlier example about wholesaling deal, flippers trying to connect with wholesalers, they would make it very well known in the market that they're looking for deals. If you have deals, please bring me the deals and I would be able to buy it with cash. So these type are the advertising. That's how you look at this particular criteria and apply it in a real life situation. In the situation, in the example of a crypto purchaser, we know a couple of clients that would make it really known that they are in the process of acquiring more and more Bitcoin in particular. Not any stablecoin, just Bitcoin. So they would do private transactions between each other because, as you know, crypto can be purchased directly from the seller. So in those cases, they are also making it known to the market that they are acquiring Bitcoin. They're out there to hunt down more deals. That's how you apply advertising effort. The second last criteria, the eighth criteria, specifically applies to shares. So depending on how you trade your shares, if the shares are speculative in nature, last year I remember there's the speculative move on investing on GME stock. You can search GME in 2021. You will know that there was a short squeeze on GME shares. Too many people short GME, and therefore Robinhood's investor came in and bid the price all the way up, and in a short period of time. So essentially, the shares rose for speculative in nature. The rise of the shares price is speculative in nature. It's very likely that those particular transactions, if you made money on it, should be considered business income because they're speculative in nature. And CRA also look at if the shares pay dividends. In the case of properties, do these properties generate rent or any other type of income? Now, the last but not least, almost arguably the most important one, is the taxpayer's intention. If your intention is to do a one-off transaction that allows you to generate some quick profit, such as in the case of using insider information, if you work for a big bank or you work for a private wealth management that help company to go public, and you have some insider information and you use the insider information that's not available to public to realize a quick profit, the profit you make is still considered on the income account in the eyes of CRA because you're utilizing some special information to get to make a quick profit. Just because your frequency of trade could be just one does not necessarily mean that CRA is not going to look at your intention. It does not mean that the transaction is automatically falling into the capital gain or capital loss bucket. It may still be considered in the income account, business profit, business loss bucket. Now that we've covered everything about how to determine whether a loss or gain, on the capital side, 50% taxable, and the losses incurred would only be 50% deductible as well, versus business side, business income and business loss, everything is 100% deductible, also 100% taxable. It is important to mention that CRA doesn't only look at one criteria to make their conclusion. They actually look at all of the criteria that I mentioned earlier to come to the conclusion whether your transaction is considered on the capital bucket or on the business bucket. It's also worthwhile to mention that losses happening inside your RSP or TFSA in the registered account is not the same as losses that are happening outside of your registered account. Now, losses that happen in your RSP, for example, you purchase Tesla at stock for over $1,000, and now today, I think yesterday or a couple days ago, it was trading below $700. Let's just assume it's $700 for my example's sake. You lost $300. Immediately, you sell it off because you're scared. So you lost $300 per shares in your Tesla stock that you use your RSP funds to invest in. That $30 is not taxable because now all of a sudden you have less money to withdraw from your RSP. So the way that it's being applied is to minimize essentially the losses that you incur would be used to lower the amount of money available for you to withdraw from your RSP. So it doesn't really help you. It's just losses are lost. Losses are gone within the RSP account. Now, on the other hand, you have TFSA account. If you incur the same loss in the TFSA account, the $300 in my Tesla example, when you incur the losses in the TFSA account, that means you have less money to invest in your TFSA account. And again, when you withdraw it, the amount of withdrawal is less, so you lose the contribution room as well. It is not essentially, it's not taxable, it's not offset against any other income other than the income or gain that you earn within your TFSA account. Now that we have discussed all these losses, business loss versus capital loss, we have a solid understanding of how to determine a particular transaction as capital loss or business loss. I know it's not really solid because it's always in this gray area, but that's how CRA operates. They are always operating in the gray area. So let's say we are now having a basic understanding, maybe using the word basic understanding is more appropriate. We've talked about reporting the loss, and there is the taxable benefit of reporting the loss. But what is your after-tax loss? What does that mean to have after-tax loss? Now, the after-tax loss is the true loss that you are experiencing. The true loss is the losses that you have incurred after taking into account the tax implication. Let's use an example to explain. Now, let's say you lose $50,000 on the UST stablecoin, and you typically hold crypto and stablecoin as long-term investments. So based on the criteria that we discussed earlier, so your loss is considered capital loss. In other words, only $25,000 of your loss is considered taxable loss, and your $25,000 taxable loss, so $50,000 actual loss, multiplied by 50%, because it is capital loss, only 50% can be applied. So this $25,000 of taxable loss is then offset against your taxable capital gain that you incur in the same year, or it can be offset against taxable capital gain that you incur in 3 previous years, or you can carry it forward indefinitely to be applied to your future taxable capital gain. Now, let's say everything happened in the same year for simplicity's sake. If your marginal tax rate in the current year is 50%, and you assuming that you own this stable coin in your personal name, your marginal tax rate is 50%, you could potentially save as much as $12,500 taxes. Taking $25,000 multiplied by the 50% marginal tax rate equals $12,500 of tax payable against any taxable capital gain. Now, if you don't earn any capital gain in the same year, the losses can be, like I mentioned before, apply against 3 previous years capital gain that you've earned, or any future capital gain that you earn in the following years. It's also worth mentioning there is a difference between realized and unrealized losses. You might have an unrealized amount of losses sitting in your stock portfolio because you haven't realized them. You don't care. I have probably lost a couple $1,000s in my RSP account. I have incurred that. I haven't realized it because I haven't sold the stock. You might think that you have a lot of losses, but these losses have to be realized before CRA recognize them as true losses. Depending on the asset type that you have the losses, you incur the losses on, some are as simple as selling the stock in the open market and realize the losses. Some can be quite complicated. You might have a large portfolio of crypto assets, but if you don't realize the loss, no unrealized losses can be offset against any of the profit that you make. Now, let's use an example to explain. You have incurred this paper loss that you haven't realized because you haven't, the $50,000 example that I used before. Say you have incurred $50,000 on unrealized losses on owning stablecoin UST. So it is on paper, you check the crypto price, it is $50,000 less, and you have this unrealized loss sitting in your account. What can you do? If you are planning to sell a property in the future to retire, and you incur a bunch of capital gain on that property, at the end of the year or during this particular taxation year that you are in, you could essentially realize the loss on the stable coin from UST and make it happen and sell it off at a loss, as much as you believe in crypto. Maybe this is the time to realize the loss. So then you can use that loss, turn around and apply against the capital gain that you earn from your rental property to lower the amounts of taxes that you would otherwise have to pay on your rental property. But the key here is that you have to realize the gain. You have to sell the crypto to realize the gain or the loss. Otherwise, the loss would not be able to be applied to other sources of capital gain. Now that we've covered the type of tax losses available, business versus capital losses, we've covered their respective attributes. Some can be applied 100%, business loss can be applied 100% against all sources of income, whereas capital losses can only be 50% apply against capital gain. So we've covered all that, and we also cover realized and unrealized losses. We've covered the true after-tax cost. I want to use our next video in particular to dive deeper into the losses incurred in different type of investment instruments and strategy. So we're going to use our next video to cover crypto losses. We're going to use the next video to cover the real estate investment loss, private lending loss, because I know a lot of clients are losing money on the private lending deal. Stock market loss as well. So stay tuned. Make sure you hit the subscribe button if you haven't, because you want to stay up to date and stay notified when our next video comes out. Until next time, thanks for watching.